Thanks everybody for joining us and me today, folks. I'll do a fuller introduction on myself here in just a couple of minutes. But you're gonna find yourself switching gears a little bit here from the technical to the fundamental world, and focused more on an investing strategy than a trading strategy. So I will walk you through three really very, very cool things today called the plan, the rules, and the right stocks. I'll share all of that with you as we get rolling here. And by the end of this, you'll have a little strategy that you can use to accelerate the growth of your portfolio or your money, however you choose to use it. But first and foremost, and simply because we have lawyers and we have to make them happy, do have to give you our quick disclaimer. Obviously, everybody knows that Forex future stock and options trading is not for everybody. There is substantial risk of loss associated with trading these markets. Losses can and will occur. No system or methodology has ever been developed that can guarantee profits or ensure freedom from losses. No representation or implication is being made that using the Millionaire Blueprint methodology, system, or the information or in this presentation will generate profits or ensure freedom from losses. Side effects may include headache, bleary eyes, coughing, the usual. If you enjoy watching grass grow, water boil, or paint dry, you're welcome to read our full disclosure and disclaimer on tradersreserve.com or millionaire-blueprint.com. So now that we told you that you won't make money, let's tell you how you actually can. What I'm going to share with you today is, in its entirety, a step-by-step investing plan that's specifically designed to create a portfolio that has a value of $1 million or more. And it includes a unique investing plan that you'll use to accelerate the growth of your money so that you can reach that $1 million goal in usually less time than it takes most people to pay off a car loan. It also includes specific yet very easy to follow rules so that you automatically secure investing gains and prevent portfolio wrecking losses. And it includes one number that you need to know so that you know that you're buying the right stocks and avoiding the wrong stocks. When you put these three components together, you'll have a powerful yet very safe strategy that can grow your portfolio because you'll be compounding your returns every single month. Not every year, every month. As I dive into this, I want to be clear that this strategy, this presentation, is not about high-risk investing, penny stocks, day trading, a get-rich-quick scheme, Forex trading, or real estate speculation. We are and will be focused on investing in stocks and in the stock market, perhaps not in a way that you might think. You'll find this, may find this a little bit different. And I know that many folks are concerned, because I talk to them frequently in webinars just like this one, that stocks have gone up so far, so fast, since the 2008-2009 financial crisis, that folks may be worried about being in another bubble, may be worried that the stock market can't keep going higher. They're worried about buying the top or selling the bottom again. And frankly, we at the Millionaire Blueprint have and share the same concerns. And that's why what you're about to learn is actually very powerful for you, because it puts some control back in your hands. And if you can follow some simple rules, what you'll discover that it doesn't matter whether the market is rising or falling, you'll have a strategy to profit in any market condition. You won't worry about buying the top, because this one number strategy I'm going to teach you here today ensures that you're buying the right stocks, not the whole market. And that provides you with really limitless profit opportunity on a monthly basis. You'll also learn our unique investing plan and how it protects your portfolio automatically against bear markets, against big corrections, against huge losses. You'll see why and how in the rules section in just a couple of moments. But you may be curious about why we've chosen $1 million as the goal, and why not 2 million or 10 or some ridiculous number like 100 million. And the reason is very simple, because if you're 40 years old or older, you are likely facing what Forbes magazine calls the greatest retirement crisis in American history. It's one that will leave millions of Americans poor in their later years. And here's why. The average portfolio in the U.S. right now is $50,000. Yet, according to all the experts, just to have a secure retirement, you need at least $750,000. Now, by secure retirement, I'm not talking about owning vineyards in France, private islands in the Bahamas, or your own fleet of private jets. I'm talking about having enough money to survive and enjoy retirement. That's how I define secure retirement. And that difference between what people need for retirement and what people have for retirement today is what we call the retirement gap. If you don't have a plan to make this gap up, you will be one of those people relying on the government in retirement. And the retirement gap is based on very simple math. If right now in the U.S., the average person makes $52,000 per year, retires at 67, and lives on average about 15 years beyond retirement. So just to maintain an average standard of living in retirement, you'd need at least $780,000 in pre-tax dollars. That's $780,000 just for retirement. That doesn't account for things such as buying a home if you're a younger investor, or if you're a parent and have kids heading off to college. There's big numbers there. You know, college education now is ridiculously expensive. Vacation or travel in your later years if you want to be able to enjoy some time to do the things that you want to do. And then we have future medical expenses. The AARP recently reported that retirees can expect to need at least $240,000 to cover future medical expenses, government health care notwithstanding. That one category is the fastest growing money killer for retirees and near retirees today. So when you add it all up, this is why we set our initial goal at $1 million. Once we get there, then we can talk about 2 million or 10 million or more, but let's get to that $1 million first. The problem is most people don't have $1 million and aren't anywhere close to that number. And really, for those of you out there who are in that situation, you're not alone. As I said, the average portfolio size is just over $50,000, which means the average retirement gap is over $700,000. So you're a pretty long way from $1 million. How are you going to get there? I'll be blunt. I'll be straight up. You've got to be able to and be willing to invest in individual stocks again. Most of you probably are, but with some changes to the way you approach it, and I'll explain that as we go through this presentation. But put simply, the first thing to realize is that you don't have the same low-risk choices to balance your portfolio that you did have 5 or even 7 years ago. That means being willing to accept some risk is a necessity. And we'll show you how to limit that risk. Traders and those of us in the investing world will always talk about limiting your risk. And the reason for that is to ensure that you're never in danger of losing it all when you learn this or any approach. And keep in mind that for most investors, time is working against us nowadays. You know, those typical investing models of having 50 years from the time you start working until the time you retire, we don't have 50 years. Most people are close to retirement. So the ability to speed up the growth of your money is critical. And frankly, if people out there are still thinking that stocks are dangerous, you'll be surprised to find that they're far less dangerous now than bonds, CDs, savings accounts, all of which have crashed far worse than the stock market. Now look at some of these numbers. For safe investments, interest rates on CDs and savings accounts have declined by over 85% since 2008. That's in just 6 years. U.S. Treasuries, safest investment on the planet, yields are down over 50%. Yet the stock market is breaking into new high territory almost every month. So how is that possible? Well, first and foremost, what we like to teach in our programs and at Traders Reserve is we are in a stock picker's market. What that means is the divergence between the movement in individual stock prices and the underlying indexes is at its highest level in over 10 years. So by being able to identify the right stocks at the right time, you have better profit opportunities than you do buying an index, and I'll show you that in just a little bit. But we also have to accept that the market is no longer buy and hold. It does not mean that buy and hold is dead, but understand that high-frequency trading, program trading on Wall Street, all of this has changed the way the market works to be a trading environment and not an investing landscape such as what we had 15, 20 years ago. So we have to make some changes or really risk being left behind. And that's why I'm here, to help you prevent that from happening. As Dan did said in my introduction, my name is John Hutchinson. I'm the creator of the Millionaire Blueprint and the investing strategy that you're about to learn. I'm also a published author. My book, The Wealth Shield, How to Invest and Protect Your Money, can be found on Amazon.com. And I'm also one of the publishers here at Traders Reserve and MainStreetInvestor.com. And as he said, I'm best known as a wealth building expert and strategist, helping people restore their retirement dreams. So let's dive in. Again, we'll try to make up a little bit of time for Dan and everybody here. We were talking about stocks and sort of the need to embrace some changes. And one of the things that you need to pay attention to or be aware of is that most investors are still making a significant mistake when it comes to investing. And that mistake is that they're following the same investing models of the last 15 years. Now, I already talked about sort of buy and hold, but the way that portfolios are being diversified between equities and bonds, et cetera, it hasn't changed. It has not changed one bit, despite the way the market has changed. And here's the reality. In that 15 years, the average return for most investors is less than 3% per year. And even with the rosy future returns, which we know never come to pass, those are expected to be around 7% per year. And you probably think, hey, 7% per year, that sounds pretty good. But if you're behind on your investing goals, here's a little reality for you. You could put $10,000 into the market every single year. And if you get that 7% per year, it would take you 30 years to reach $1 million goal. Now, that's if you put $10,000 into the market every year and if you get that 7% per year. Not only are there too many ifs in that scenario, but the reality is most people don't have 30 years. So if you wanted to achieve those retirement goals, again, you have to make some minor changes. And it's these buy and hold models that are the ones that are projected to return 7% per year. So let me show you, though, how the typical model for most investors doesn't get it done for you with a little other chart explanation. This shows how your money would have grown if you had just invested in an S&P 500 index fund over the last 15 years, something that millions of investors actually have done and are still doing. Now, we know the market's at new highs, so you probably think that this means, hey, I should be raking it in. But nothing could be further from the truth. This is the great lie about buy and hold. This is why active investing is becoming the fastest growth category in the investing marketplace. Because buy and hold, index fund investing, this tends to decrease your annualized rate of return, even when the market can be up 10, 15, 20, 25% in a single year. Over the course of time, your annualized returns decrease. Here, if you would put $10,000 into the S&P 500 index fund every year over the last 15 years, your actual rate of return was 2.9% per year. And at that rate, it would take you 50 years to reach $1 million portfolio. So 50 years. So along with savings accounts, CDs, bonds, and now even index funds, how are we ever going to get to $1 million portfolio, right? It's called hyper-compounding. You can do this safely. You can do it consistently in a portfolio. Doesn't matter whether you have an IRA, a Roth, a regular brokerage investing account. If you can buy and sell a stock and follow some simple rules, in 8 years or less, this could be your portfolio. That's $1 million in about 8 years. And I completely understand and expect you to be a little skeptical, but the purpose of this training today is to show you how it can be done. And the first step is to change the way you think about your portfolio and think about it in terms of time. In order to reach these financial goals of getting to $1 million, your portfolio needs to be structured based on how long you want to hold an investment with a specific profit objective in mind. What I'll teach you today is how to use short-term investing in stocks to accelerate your returns by compounding gains monthly, not annually, monthly. And that will help you to grow your portfolio faster than you probably think is possible. And I want to make it clear again, this is not day trading. Now, to do this, you'll use just part of your total portfolio, depending upon your total capital available, maybe 10% at the top end. But you'll get this is how you'll be able to get this explosive growth of your money and still keep your overall portfolio safe. And you'll also discover that you can hold fewer stocks in your portfolio, so this doesn't take hours of time to manage. But with these specific profit objectives, they're based on how long you want to hold a stock investment. Now, our little pie chart there has short-term, medium-term, and long-term. And just for the sake of quick definitions, and I'll cover this again in a couple of slides, short-term are stocks or ETFs or other assets that we're holding from essentially 1 to 3 months. Medium-term are assets that we would hold for up to 6 months. Long-term are assets we would hold for 1 to maybe 2 years, sometimes longer, but generally in those time frames. And the profit objectives I'll share with you a little bit later in the presentation when I talk about the rules are specific to each of those time frames. So for example, we're going to have a specific profit objective whenever we buy a stock in our short-term portfolio. And the reason for that is to ensure that we take these gains and then start compounding our money on a regular basis. That's the hyper-compounding strategy. And I want to explain this to you in a little bit more depth. So this is sort of like my important lesson of the day. You may want to write this down. But the key to successfully growing your portfolio is determined by increasing the annualized rate of return on your money. This is the power of hyper-compounding, and I'll demonstrate this quickly here for you. Basic linear math, just so you get the concept, the simplicity of it. Let's assume that you're starting with $10,000 and you get an average return per month from your investments of 4%. Now that's per month, not per year. After 12 months, your $10,000 would grow to $16,000. That's an annual return of 60%. Now, that 4% per month is the compounding strategy. Here's the hyper. If you follow the same plan for a second year, starting with that $16,000 in the second year and still generating that 4% return per month, your money would grow to over $26,600 by the end of the second year. But your annualized rate of return has increased to 83%. And notice that in 2 years, just 2 years, you've more than doubled your money, but you never added a single penny. This is how important the concept of hyper-compounding is for investors. Being able to capture returns on a regular basis, compound those returns, and turn your portfolio into essentially a hyper-compounding machine. So let me dive into some of the simple details behind our portfolio plan. And the first step is to determine how much money you can start with. This is obvious, but it's also important. And the reason is you don't have to take stupid risks with your money. This is something we teach frequently. Regardless of how much money you do or do not have, we typically ask our people to start with 10% of their portfolio if they're a larger investor, or up to or a minimum of about $10,000. And you'll see why as I go through a couple of the additional steps here. But we have had people who have started this with as little as $2,500. They start small, they grow rapidly, they get to that $10,000 mark, and then they can take advantage of even more stocks to compound their money. But the reason that you're doing this, the reason you're only taking a part of your portfolio is for risk management. What this does, this little slice of the pie, it ensures that no one stock that you can invest in can ever hurt your full portfolio. It ensures that even if one stock goes wrong, it will not dramatically affect your overall returns because other stocks can still make up for those stocks that are down. So again, if you do have less money to begin with, though, I'll be honest, you do have to take on a little more risk because you need that faster growth. You need to get to this $10,000 starting point, but a little more on that later. The next step, though, and this is a money management tactic, is to divide that capital into 10 equally weighted groups or buckets. Now, so if you're starting with $10,000, you'd have 10 capital buckets. Each of those buckets would have $1,000 in it to start with. And each bucket then would hold one stock at a time. So the maximum number of stocks you're holding here is 10. Now, this is an additional risk management tool. Again, it helps you to reduce your overall risk exposure, and it also acts to protect your portfolio from big or significant losses. Although when we get to the rules section here in just a moment, you'll see how to further limit your risk, but not necessarily or hold you back from achieving profit goals. So these are the 2 key steps to get started with the plan. Again, you're beginning with short-term investing to get that fast growth of your money, and then you're dividing your capital into these 10 capital groups so that your opportunity is spread across 10 stocks, but again, you're limiting your risk by this capital division tactic. So I'll say again, I know I say it too many times already, this is not day trading. Again, these are short-term investments, which are stocks or other assets that are held from 1 to 3 months and have a specific profit objective, a target. Our gains are compounded monthly instead of annually. And in our program, we target between 2 and 8% returns per month. That gives us a potential for an annual rate of return of up to 80% per year. And it's that 80% per year, if you're averaging that over the course of 8 years, that you can use to grow $10,000 up to $1 million. I'll show you the speed at which we're actually growing a little bit later as we get through this presentation. what you'll discover is that you can make more money faster with just this little part of your portfolio using short-term investing with these goals in mind and never risk losing it all. That does, however, bring me to the second of the big mistakes that investors are making. I mean, it segues us into the rules section. So we've sort of taken a look at the plan. Now we're going to take a look at the rules, and then I'm going to show you how to find the right stocks to use in this process. But the mistake that most investors are making is that hope is not a strategy. To be successful with this or any investment plan, you need three things: a simple, repeatable process to come out ahead, easy to follow rules that don't take a lot of time, and a smart way to protect your money. But the question that should be asked is why people actually lose money. And the simplest answer is emotion. We all know this, and we all still ignore the reality of it. But to understand this a little better, I'll share a brief story here. A number of years ago, I was on a flight to Las Vegas, and the guy that I was sitting next to, he was from New York, a pretty successful business person. He was, at the time, more successful than I was. And we were talking about gambling, and I asked him, why he thought most people lose money in Las Vegas. And here's what he said. He said, people lose money because they don't have triggers to quit. Their emotional high or low gets in the way of making a rational decision. And I have, he said, two triggers, a profit trigger and a loss trigger. Whichever one I hit first, I pull that trigger and leave the tables for the night. Well, the more I thought about that idea, the more I realized it's the same principle when you invest, right? You have to have triggers. But most investors don't have a loss trigger. They have a hope trigger. If a stock goes down, they just hope the stock will come back. And they don't have a profit trigger. When the stock goes up, they just hope it keeps going higher. So, I mean, think about the last time you made an investment in a stock, and did you ever have the stock fall by 10, 20, or 30% and just say to yourself, well, I hope it comes back? Did you ever have a stock that went up 10, 20, or 30% and say, well, I hope it just keeps going higher? This is exactly what happened. This is the emotional interference that occurs to all of us. And then what happens usually is the stock goes down, you give back all your gains, you're back to square one. That's usually what happens to us. And that's why this idea of hope is actually a recipe for disaster. It's what wrecks investors' money. But I'm going to give you our key, what we've done to our key to success, and the way that we remove emotion from the equation. It's not easy. Even, I'll be honest, despite my triggers, despite my rules, even I still suffer from the emotional interference from time to time. It happens to all of us. But most importantly, by using what we call decision triggers, we can remove emotion from the equation. And that means getting rid of fear, greed, and hope. And that's because by using what we call profit triggers and loss triggers, you establish your profit target and your risk in advance so that you can automatically secure an investment gain or protect yourself from a big loss. And the reason for that is because when you learn to use decision triggers, you are making your decisions before you commit your money to the stock market or any investment for that matter. So I'll say that again. With these two triggers, your decisions are made before you put your money in the stock market. So let me segue then into teaching you our rules for investing. And then in a few minutes, I'll share some trade examples so that you can see these decision triggers in action and how they do that, how they secure those gains and protect you from big losses. But let's quickly review the first couple of steps in the plan again. Remember that the first two steps were to, one, determine your short-term investing capital base. I'm going to use $10,000 as the assumed base here for our teaching purposes this morning. But the next step was to divide that capital into 10 buckets, each bucket being $1,000. The next step is to set our decision triggers, and those decision triggers are based on our short-term rules to investing. And our short-term rules are a 20% profit trigger and a 10% loss trigger. Every stock that we're investing in for short-term investing has the same profit and loss triggers. This keeps it simple. It's also how you secure investing gains and prevent big losses, because you're using these triggers to make the only two decisions that matter. When you hit that 20% target, you want to take those gains so that you start the hyper-compounding process of turning your money over month after month. And the reason for that is because you'll use the capital that you just earned on the first trade and reinvest it in the next trade. And the benefit here to you is that it really also helps you prevent giving back a gain. Remember, we're working in up to a 90-day time frame. If we make 20% anywhere in that time frame, we want to take our gain and move on to another opportunity. But you also have to protect your money, and to do that, you use a 10% loss trigger. Now, I'll be clear on something here. A loss trigger does not have to be a stop-loss order, and in many cases, it shouldn't be. It's a decision point where you can make a rational, fundamental decision to minimize your losses and move on to another stock. And the key thing here is to prevent that small loss of 10% from ever turning into a big loss. And that's primarily what happened to most people back in 2008, 2009. They watched as their stocks dropped 20, 40, 80% in value and didn't protect themselves with a loss trigger. But when you put all this together, sort of the plan and the rules, what you discover is that you don't have to be afraid of hitting singles and doubles. I'm a big baseball fan. Can't wait for next week when the baseball season starts up. But winning in the markets, to me, remains just like playing baseball. You can score more often and with realistic gains by consistently hitting singles and doubles rather than swinging for the home run trade every at bat. And listen, I love the home run trade too, but the truth is they're few and far between. Singles and doubles, they happen every month. So we've covered the plan, we've covered the rules. In just a few minutes, I'll tell you how you can get your hands on the Millionaire Blueprint, which details in a little bit more depth the investing plan and the 2010 rules. But next up is we need to talk about how to find the right stocks, how to find those stocks in those short-term time frames that will move those 20% for you. Now, there's a second half to my program. His name is Jamie DeLugash. He's our investing expert. Obviously, to keep things simple, only one of us could do the webinar today. But if you don't know Jamie, he is a 25-year veteran of the stock market and an investment professional. Hulbert Financial Digest previously ranked his Rational Investor a #1 newsletter, and he currently writes for reputable websites such as ours, TradersReserve.com, MSN Money, and others. He's also the author of a forthcoming book called The Manipulators, Beating Wall Street's Earnings Game, which is due out next month on Amazon.com. Now, the process that he uses to find the right stocks centers on one number. You'll learn how simple this number is to calculate in just a couple of minutes, but as the expert in the Millionaire Blueprint Program, he starts with a computer-based algorithm to rank all of the publicly traded companies at the end of every month. He then reviews those rankings by sector and market cap, largely to avoid overexposure, and then uses a qualitative analysis approach to re-rank the stocks into a top 10 each month. And all of these stocks are the ones that we're using in our short-term investing portfolio. Remember, we divided our capital into 10 groups, so now we would have 10 stocks to take up those 10 capital groups. And all of these stocks are based on one number, which is used to identify the best stocks to own. And that one number is what we call the PE gap. Now, this is where we're going to dive into some fundamental analysis, but it's very simple. In fact, if you have a calculator, you can do this along with me at home in just a minute. But the PE gap occurs when there is a difference between a company's price-to-earnings ratio and the company's earnings growth rate. Now, again, this is simple to do, so don't worry about getting all bleary-eyed here, but what you're looking for are these two things. When the price-to-earnings ratio is greater than the earnings growth rate, that means you have an overvalued stock, and it's typically one you'll want to avoid. When the price-to-earnings ratio is less than the earnings growth rate, that means you have an undervalued stock, and it's one that you typically want to buy. And a little tip here, the wider the gap between the price-to-earnings ratio and the earnings growth rate, the better the opportunity can be, because we see these gaps trigger gains of 15 to 30% in short-term investing time frames. And if you think back to our rules and our triggers, what was our profit trigger? 20%, which is right in the sweet spot of the types of gains that we see in undervalued stocks using this one number approach. And what we're doing here is essentially buying growth at a discounted price. This is what this number helps us to accomplish. So let's take a quick look at an example, and then we'll dive into how to calculate this one number. This company is Manitowoc. The stock symbol is MTW. They are a heavy crane manufacturer. It is a stock that our PE gap approach identified at the end of November 2013. I do have some fresher examples to share with you in a couple of moments, but for simplicity here, the stock had a PE ratio of 16, an earnings growth rate of 19, which yielded a -3 PE gap. There, then, the PE ratio is less than the earnings growth rate. We have an undervalued stock that we would want to buy. And in this particular instance, we recommended Manitowoc at the beginning of December 2013. We had an entry price of $20.59. And this, the chart there shows you what we call the escalator move. These are stocks that over a period of time, they're not just moving straight up, but the trajectory, the channel is running in bullish direction here, obviously. You'll have breakdowns, you'll have breakouts, but the key thing here is this escalator move it starts rather by identifying that stock at an undervalued point and then riding it up for as much of a profit opportunity as is possible. Based on our trigger here, 20%. You can see that with Manitowoc, we got that in about 30 days. Just over 30 days, rather, excuse me, early January of 2014. But notice that the stock continued on for up to nearly a 50% gain in just over 60 days. So all of these are possible. I mean, this is what is possible, excuse me. But that's how powerful this approach can be. Fast gains, and then you turn this, you take your 20%, you turn it over to another stock, repeat the process. So let's get back to the lesson on PE gaps here, though. This is the quick lesson, again, to know what to do. When the PE gap is negative, again, you'll see how to calculate this in a second. That means the PE ratio is less than the earnings growth rate. It means the company is undervalued today against the future expectations of the company. That's a stock you want to buy. When the PE gap is positive, it means the PE ratio is greater than the earnings growth rate, which means the company is overvalued today against those same future expectations of the company. That's typically a stock that you want to avoid or potentially short. Now, we do not short stocks in our Millionaire Blueprint program. Details on that a little later. But for those who like to play both sides of the market, you have a little powerful little weapon here that you can use. And last but not least, as I said earlier, remember that the wider that gap, the better the opportunity for short-term gains. Now, I'm going to show you how to calculate on the next slide the PE gap. And I want to stop here for one quick second and make a quick note on something here, especially as it relates to price-to-earnings ratios. When you're looking this information up on typical web portals, financial websites, understand that the PE ratios that you're looking at are a rear-view mirror number. It means typically PE ratios are calculated on a trailing 12 months basis. So it's based on the money that the company already earned in the prior 12 months. The problem with that is the stock market is pricing stocks in the future, not in the past. So the issue from a fundamental perspective is you're using a number that looks backwards to price a stock looking forward. Doesn't work that way. So what this PE gap approach will change is help you to calculate a forward-looking price-to-earnings ratio along with a forward-looking earnings growth rate so that you have the potential to look in the same direction as Wall Street. So let's dive into how this is done. You only need three numbers. I'm going to use an example, American Airlines. This is an open trade that we've had running since October of last year. Kind of will give away how we've done on this one. Keep in mind the numbers that you're looking here were, as you can see on the screen there, from December 22nd of last year, so just a few months ago. But the key thing here is we use Yahoo Finance to get the information we need. Any financial portal will do as long as you can get these three numbers. Obviously the current stock price, but most importantly the earnings estimates for the current year and for the next fiscal year. On Yahoo Finance, once you type in a stock symbol, if you look down that left-hand menu, you'll see Analyst Estimates. You click on that tab, and that gets you into this information. So once you have these three numbers, it's actually pretty easy to calculate the gap. So I'm going to show you how to do that now. But here in our example, we have $51.40 for American Airlines as our current price. We have $5.72 as our current year earnings and $8.42 as next year's earnings. Now, again, this was a snapshot taken at the end of last year, so these numbers would in Yahoo would now show 2015, 2016 as current year next year, and the numbers have increased dramatically because of the changes in the price of oil. Decline in oil. So, but let's move on. Here's how to calculate the price-to-earnings ratio. Again, on a forward-looking basis, you divide the current price by the current year's earnings estimates. So in our American Airlines example, $51.40 divided by $5.72 gives us a PE ratio of 9. Now, to put that in perspective, keep in mind that typical fair valuation on the S&P 500 is between 16 and 18. 18 right now is about where the markets have been running. It's a little to the high side historically, but typically 16 is considered fair valuation. as a PE ratio. You can have numbers that are higher, you can have numbers that are substantially higher, but that's just to give you a little bit of a grounding in some of these numbers. Next up, we want to calculate the earnings growth rate. To do that, you would divide next year's earnings by the current year's earnings. So this will tell you the rate at which the company is expected to grow profits. In the American Airlines example, we have $8.42, that's next year's earnings, divided by $5.72, which is the current year's earnings estimate, which gives us a 1.47 return. You subtract 1 from that number to get a percentage return, and so in this example, our actual earnings growth rate is 47%. The next step is relatively simple. We subtract one number from the other. So it's the PE ratio minus the earnings growth rate, which yields the PE gap. So in our example here, we had a PE ratio of 9, an earnings growth rate of 47, which gives us a negative PE gap of minus 38. It's that simple. So our gap again is negative, which means the company is undervalued. In other words, we have the opportunity to buy substantial growth at a discounted price, and we would want to buy this stock at current prices. So let me put everything together for you now so you can see sort of the plan, the rules, the right stock, all of this in action together. This again is American Airlines. This is an actual recommendation we made at the end of September 2014. We're still holding this stock. And the first step, we would take one of those 10 capital buckets, so basically $1,000, and we would use American Airlines in that bucket. That next step then is to make our decisions before we commit to the market. Now in our program, we're not market timers. We enter at the beginning of every month, again, because we're running our scan at our rankings at the end of each month. So we're simply entering on the first trading day of each month. So in fact, we're starting today with for April stock selections. So again, we would have used one capital bucket, and then we would have executed this trade on the first trading day of October 2014, and the price there on that opening day was $34.50. So you've pretty much already seen how this trade turns out. So much for drama. But again, you have to make your decisions on your profit and loss trigger. So using our rules, we would multiply that entry price by 1.2 to set our profit trigger. So $34.50 times 1.2 equals $41.40. That's our profit trigger. Then we need our loss trigger. So we would multiply the entry price by 0.9. So $34.50 times 0.9 equals $31.05. That's our loss trigger. So now we've set a ceiling for our gains. We've set a floor to minimize our potential loss. The next step is to let the market do the work for us and let the trade run to conclusion. Again, here's how that worked out. In just over 30 days, in fact, within 30 days, by the end of the month, we reached our 20% profit target. Now, if you'll recall back to the pie chart, you saw that there was a short-term, medium-term, and long-term part to the portfolio. So here's an example where we got to that 20% so rapidly, but the underlying fundamentals of the stock and the PE gap continued to show this stock as being significantly undervalued, and it was, that we moved it to our medium-term portfolio to hold it for up to 6 months. And that move doubles the profit target from 20% to 40%. It's just adding another 20% on top. Well, you can see what happened after we did that is the stock moved right up and grabbed our 40% profit target by the end of November. And at that time, we liked it so much that we moved it to our long-term portfolio. We're still holding it today at about a 52 or 53% gain overall, and our exit target is $69. But the process here shows you that you can move, stock can move rapidly enough that you have that choice to either just simply take the gain or hold potentially for a larger gain, still following some basic and simple rules. Now let me show you what happens when things go wrong. This is an example of the loss trigger coming into play, and basically to help you. So this company is US Silica. The stock symbol is SLCA. It was a November 2014 recommendation, which at the time had a negative 35 PE gap. So it's a big gap. But we were cautious on this one because it's tied to the oil industry. They're tied to the fracking industry. And at the time, oil prices were in that big decline, that precipitous decline. So we were cautious with this one. We had an opportunity. We still took that opportunity, but we still have to make our decisions first. So remember, we would have taken one bucket and then entered on the first trading day of the month, which was November 3rd. The opening price was $45.57. We do the next two quick steps, setting our profit trigger at $54.68, 20% above, and our loss trigger, $41.01, at 10% below our entry price. So again, we've set our ceiling, we've set our floor, we're following the rules, we have a fundamental basis for making this trade, and it didn't work out. So here's what happened. Now this, you can see that ultimately the stock dropped significantly off the shelf, and I'll get to that in a moment. But right at the beginning on our entry day, you can see the market started moving down. There was a gap down move on the 4th that triggered our 10% loss trigger, so we exited the stock the very next trading day. So we exited ultimately with about an 8.5% loss. Now, the stock did move and recover back up to its entry price. You could have held on for that, but if you'd held on just a little too long here, letting hope sort of be your guide, you could see what happened as the oil markets rolled over. U.S. Silica went with them all the way down to essentially $28 a share and even further lower. But what this did, this loss trigger did, it minimized our loss. We were out quickly. We got ourselves out of the way of a bad trade and protected ourselves from a significant loss. Now, lest you let one trade get you down, let me introduce you to one of our other November stock selections. Again, this is November 2014, so just a few months ago. And keep in mind that with that silica trade, basically what that meant is on a 10% loss trigger on that $1,000, you lost $100. Now, here's the opposite end of that. Here's Meritor, and this company had a negative 20 PE gap in the same month that we were trading U.S. Silica. So again, we go back to the rules. We take another bucket. This was the opening price, $11.55 on November 3rd. We set our profit trigger. We set our loss trigger, so $13.86, $10.40. Those are our ceiling, our floor. We let the market do the work for us, and that's much better. 9 days later, we had a winner, another 20% winner. Ultimately, we actually moved this into our medium-term portfolio where it was up to about a 32% gain at one point. So in the same month, though, had you just closed these trades out, which is really what I like to see happen, you had one trade that lost 8.5%, one trade that gained 20%. So across those two trades, when you sort of add the numbers together, you would have been ahead by $115, or 1.15%. So keep this kind of context in mind, because remember, you had 8 other buckets that were still running for you at the same time, but that's just 2 trades. There's generating that 1.1% return in the month. You do this month after month after month. This is how you start that hyper-compounding process. Number one, you don't have to win every trade. You're trading at a 2-to-1 risk-to-reward ratio, which means that your winners, when they happen, will far outpace your losers when they happen. Number two, you don't have to win every trade, because in the expectancy model, essentially 40% winners versus 60% losers, or with 60% losers, still means you'll come out ahead at the end of every month. I know you probably don't believe that right away, but you can run the numbers. If you have 4 trades making 20% on $1,000, you're making $800. If you have 6 trades losing 10%, at $100, that's $600. You're still ahead $200 in the month. That's how this idea of risk to reward, money management, risk management, all of this works together to protect you, but to still allow you the opportunity to come out ahead. It's not high risk investing. It doesn't take hours of time to do this. So what I want to do next is take a full run, a look at a full run of our plan. This is going to be from February of 2015. We had 10 stocks in the short-term portfolio, had a very, very strong return for the month, and obviously February was a good month. March was an okay month for us. We still pulled out about a 2.5% return for the month of March. But February, let's take a look at how that happened, and I'll walk you through sort of like the whole process here. So first of all, we needed to know what's the one number. What are the stocks that we were investing in based on that one number? So here are the 10 stocks, and as you look at that list, you'll see some fairly large, well-known names. For example, Whirlpool, United Airlines, Bank of America. So again, these are not penny stocks. These are not OTCs or pink sheets. These are good, publicly traded companies. Conn's is an electronics retailer. Bungie, USG, Sportsman's Warehouse, a small retailer. Aircastle, U.S. Silica. We actually came back to the well on U.S. Silica, and we wound up closing this one out with a gain. So that original 8.5% that we lost in November, we got it back in February. United Airlines, Tudor, Perini, and Bank of America. Those were the 10 stocks. You could see the range of PE gaps being large to small. And again, the larger the range, the larger that gap sometimes gives us some really good indication of potential big moves in the price, but sometimes the smaller gaps will do the same thing. Cons was one of our bigger winners, and we'll take a look at that here in just a second. Well, now what I want to bring in is like the portfolio approach, so you can see the plan and the rules sort of working all together for you in a single month. So cons wound up earning or generating almost a 30% return, even though our profit trigger was 20%. The reason it got out at 29% was because it gapped up over our profit trigger. So that was a benefit that we didn't expect. You can see Tudor Perini was at its 20% target by the end of the month. Whirlpool and U.S. Silica both produced positive returns. And then, we had a loser. Bungie lost 10%. We closed that trade, moved on to another opportunity when March came around. So if you had done this in February, based on the starting portfolio value, to sort of make this as real world as possible, let me show you some of the mechanics, so to speak, of this. Starting with $10,000, you would have had invested capital of about $9,648, including a rough estimate on commissions of $6.95 per trade. So you would have paid, because you would have paid commissions before executing the trades. So on the front end, you would have had about $70, and then you would have had $70 again on the back end when you cashed out. An excess cash here of about $280, because you would not have used 100% of your cash based on the stock prices here. So when you close these trades at the end of the month, your overall return was astounding. You closed with about a 9% gain on the invested capital. Now, that's not a 9% gain on your $10,000. It's a 9% gain on your invested capital. So by the end of the month, the value was $10,500. You still had your net cash. So overall, your return was calculated from $9,600 up to $10,500. That was a pretty outstanding return. And here are some examples of returns that we've been generating from month to month. Sometimes we have large months. Sometimes we're in that 2% range. January appears to be a month that we should be avoiding. We've had 2 consecutive Januaries where we've come out with just about a 1% loss. And in fairness, January 2014, we only had 5 stocks operating, not 10. So that loss is actually smaller based on the overall portfolio. But you can see the consistency of being able to generate these returns month after month after month. This is how you start that hyper-compounding process. If you generate these types of returns, 1%, 2%, 4%, 8%, you have a couple of good months, a couple of low months, they'll average out. Right now we're averaging about 5.1%. And that's how, it's right in the middle of our 2 to 8% returns monthly. That's how we can generate that 80% annual return. So this sort of gives you, since the program's inception, that's when it started, October of 2013, that's how powerful this can be. And again, if you can follow this plan, these rules, use the one number to find the right stock, use the hyper-compounding principle as I've taught it to you here today. You don't have to target 10 or you don't have to target big numbers. Aim small and let it add up for you. And that's what will happen as it starts to compound from one month to the next to the next. This is how you'll start getting on that growth path and be able to grow a small short-term investing portfolio into a $1 million powerhouse. Now, as part of this, we do have a complete program, and I'll walk you through it very quickly here and then stop and do Q&A with you. But this is how powerful the program can be for you, and it's also why I say that it's a step-by-step investing plan that's designed to create millionaires. It includes everything you need to achieve this success. You already have the plan, really, just as I taught it to you here this morning. You have the decision triggers in the Millionaire Blueprint rules, and as you've seen them in action here today, and you also have the right stocks to use inside your plan with the rules based on the simple one-number formula that you've just learned how to do here as well. But let me give you a choice this morning. You can choose to join our Millionaire Blueprint family and speed the growth of your portfolio and let us help you to do that, or you can risk going it alone. I'll remind you, going it alone means it could take you 30 to 60 years to reach those financial goals. But if you want to save yourself 40 years then I'd like you to take this opportunity to reserve a seat with us at the Millionaire Blueprint table. You can choose to join us with our simple, no-hassle, 60-day test drive for $79. That gets you complete access to the entire program, no partial access, no limited access. It's 100% complete and total access for the next 60 days for $79. You can register immediately at millionaire-blueprint.com/win. That's what we want everyone to do, win. So again, it's $79. Over those 60 days, you'll have 2 full months of complete access to the program. That will include up to 10 short-term stock selections each month. So over the next 2 months, you'll have a total of 20 stocks that you'll be working with us. And you'll be able to see right away whether this works for you, whether it's right for you, because it's not right for everybody. We know that. Now, here's exactly how the program works step by step. As I said earlier, we make our monthly trade recommendations at the end of every month. So we just made them last night. And remember, again, this is short-term investing, not day trading. So our goal is to turn our portfolio over as frequently as possible, as frequently as the market will allow. That gives us the opportunity to compound our money from one month to the next. That's the hyper-compounding strategy. Our maximum holding time is 90 days. You can see how, or you've already seen how quickly some trades can move in our favor. The Meritor, for example, within 9 days. So once you've entered your trades, typically on the first trading day or first 1 or 2 trading days of the month, then you simply follow the rules. Now, I'll remind everyone, we're not market timers. We're not technical traders. And the reason for that is we need to get every member's money in and working on the stock selections as quickly as possible. So we use market orders. You can, if you're a technical trader, if you like to watch the market, I'm sure most of you do, and you're available at the market open, you can always watch the price and pick your own entry. But the reason we publish everything at a market price rather than a limit order, quite simply, is to ensure that everyone can execute on the same trade. So once you've entered that trade, you simply follow the rules. Remember, these are your decision triggers. You'll find that we're guiding you every week along the way. You'll never be trading alone. We use multiple updates during the week and on the weekends. We use both email and text alerts to let you know that if there's an action that needs to be taken. When our 20% triggers get reached, we'll close those trades, take our gains, and move on to another opportunity the next month. So we do still have seats available for the new month, for April. Again, our stock selections just came out, so there's plenty of time to get in. Again, millionaire-blueprint.com/win. Let me briefly go through everything that you get as part of the 60-day trial. Our phone number is also on the screen right now. If you have questions, please feel free to call us. More than happy to take time to call you back or take your call and answer those questions. But again, you'll get the Millionaire Blueprint monthly stock selections on the last day of every month, or today. That includes the complete short-term investing portfolio, which is typically up to 10 stock selections for the new month, and for use with the 2010 rules to investing. You'll also get our Millionaire Blueprint report. This details the plan, the rules, everything that I've taught you here today in a little bit more depth. You also get our trade alerts, our regular updates. We do these every Tuesday and Thursday nights at 7 p.m. Eastern Time by email and also on our members' website. We also do a Saturday review. Every Saturday morning, you get our complete Saturday review. This is essentially where we give you an in-depth look at all of our open trades, the returns for each trade, and the key events that are driving all of our stock selections. And you also get our action to take alerts. Again, these are when either a profit trigger or a loss trigger is breached and we want you to take an action, we will make sure to let you know and tell you exactly what that action should be. We also include 3 free bonus reports. Our Advanced Profit Strategies report teaches you 2 simple strategies. Our risk reduction strategy, which shows you how to recapture your trading costs, and how to eliminate nearly all risk in any trade that you place. And the active investor rules show you how to capture larger gains from a winning trade by doing just one little simple thing. Then our $2,500 plan report. I told you earlier that some folks have started with as little as $2,500, so for those on a limited budget, this report helps you get to that $10,000 starting point so that you have all 10 buckets. It takes about 12 months. You can still follow the Millionaire Blueprint plan and the 2010 rules to investing. And finally, our capital management spreadsheets, which do all of the work for you in managing those 10 buckets. There's even a training video to help you. These are very simple to use Excel spreadsheets. They calculate your targets, your triggers rather. They track your returns, not only for the individual stocks that you're holding, but also for your overall short-term investing portfolio. Plus, we also have what we call our boot camp training video. This walks you step by step through what you need to do to get started right away. So you'll know how to use the capital management spreadsheets, how to place your first Millionaire Blueprint trades, what your expectations should be, and how to spend more time really doing what you enjoy doing. Plus, each month, up to twice per month, we hold live strategy sessions with me and with Jamie and with all of our members. That's where we'll help everybody stay on track. We answer any questions that folks have. We review the portfolio. We'll do live charting on the portfolio, on the trades and the stocks that we have. And from time to time, we'll do special training on other related topics. All of that's included in the Millionaire Blueprint Test Drive. You also get our Millionaire Hotline email. This is direct access to me and Jamie via a special email account. This helps you get your questions answered fast. It's essentially your lifeline for instant help. And you get access to the Millionaire Blueprint members only website. One simple page, everything you need to find is right there for you. All of the trade alerts, the stock recommendations, the Saturday review, the Tuesday, Thursday updates, all of the training materials, all the bonus reports, everything's on one easy page to grab. So you can download your stock selection reports, grab your Saturday reviews, everything that you need ready to go when you need it. And also all of our strategy sessions. We held one last night. It was actually a great session, almost 2 hours, which is a record for us. But those are always recorded, and they're archived right on the members page for you as well. And as I said, when our decision triggers are reached, you'll have instant access to the trade alerts, not only on the members' website, but also by email. And we also offer SMS text messaging for those who want to take advantage of it. And then we also have a little calendar that tells you what's on tap, what's coming up in the next week, so you always know what to expect. So you get all of this for 60 days. Again, it's our no hassle. This is an example of the members website, so you can see everything right here, where you need it, what you need, ready to go for you. Here's a quick example, too, of what you actually get inside of our stock selection reports. Again, first of all, we give you what the portfolio is going to be. These are the 10 stocks that we're going to be holding from whatever the month happens to be. But then we do the PE gap analysis for you, so you can see the fundamental rationale for why the trades are being taken. And then we also provide individual analysis on each of the stocks, so that you understand what's driving the price behind the stock, or what's the reason or the rationale for making this particular stock selection. So again, you get everything for the 60 days for $79. After the 60 days, you can choose to continue on for $79 a month, or we also give you an opportunity to upgrade and save money with an annual program we offer. So again, this is everything you need, one simple place. Once you get in and you get that stock selection report, you can instantly enter your trades. Usually we want everyone to enter on the first trading day of the month. Markets are a little dicey today, so some folks are probably waiting, and that's okay. But remember, you can always estimate the number of shares you need to buy, get your money working, get right in, then follow the rules. Follow our updates. You will not be trading on an island here or investing on an island. You'll get trade alerts and exit alerts whenever there's something that an action that needs to be taken. When those 20% triggers are reached, take those gains, close those gains, and start compounding your money and repeat the process the next month. So again, limited time. Yesterday was the deadline. I'm extending it because we were doing this webinar this morning instead of last night. Plenty of time to get in. Again, millionaire-blueprint.com/win. I'll leave that up on the screen. I'm sure Dan will throw in the chat box, the link for everybody here as well. But I'm going to start doing questions real quickly. And Dan, if you would, in the chat box, just give me a quick note on how much time I have here. Let's see. All right. Are you saying each stock is 10% of that you're overall only investing 10% of your capital? Vicky asks. Vicky, in the short-term investing, that part of your portfolio is 10% of your total portfolio. So for example, if you had a $100,000 portfolio, you would take 10% of that, or $10,000, and that's what you're starting with, and then you grow that part of your overall portfolio. That means that overall, the rest of your money can be invested in other places. You could be trading accounts, options, what have you. But this one little piece of the pie will start growing rapidly for you. So it's just that one little 10%. Smaller investors, again, do have to take more risk. If you have less than $50,000, you have to start with a larger percentage, and the reason for that is because you need to get that sort of exponential growth to get to the point where your money can be working for you. That's the reality there. So again, you can start small. If you do start small, we have people start with $2,500 to $5,000. That's fine. The key is to start with $1,000 per bucket. The reason for that is so that you're maximizing the 20% capital. You only start dividing it to a true 10 buckets when you're at the $10,000 and higher mark. Less than that, every bucket should be $1,000 or above. So an example is if you're starting with $6,200, you would have 5 individual buckets at $1,000 and 1 bucket at $1,200. And then when you get to $7,000 for your overall account, bingo, you just created your new 7th bucket. So that's how the process works, but great question. Brad asks, why not just use the PEG ratio? Again, because PEG takes into trailing 12 months account for the PE. It's not a forward-looking ratio, and it's also not an understandable number by many people. It is part of what we look at, but the PE gap is, honestly, it's a quick, simple way to understand whether a stock is under or overvalued as opposed to a more complex or complicated ratio. But a good question, Brad. Thank you for asking. Please calculate AAL with today's numbers since the 2 earnings. Rhonda, good point, good question, and let me tell you what's going on with American Airlines and most of the airlines. 2015's earnings estimates are outsized, and the reason that they are outsized is because you have essentially you have an inverse trading relationship between the airline sector and the oil markets. When oil goes down, airlines go up. When oil goes up, airlines go down. The one number that keeps changing is the current year's earnings estimates. If you look that up on Yahoo Finance and you scroll down a little further on the analyst estimates page, you can see over the last 90 days how dramatically the earnings estimates have changed for American Airlines for just this year, but less so for next year. What that's telling us is that the expectation is at some point in the next 12 to 24 months that the oil prices will start rising again, and that will put downward pressure on the overall earnings of the company. The challenge for American Airlines is right now, and it's one of those unusual circumstances where, again, you have to do a little more fundamental sleuthing. The company's 2015 earnings are higher than the 2016 earnings. So right away, it looks like they have negative earnings growth, but the reality is they don't, because the majority, 20% of those earnings for 2015 are specifically related to the price of oil. So it's that in that particular instance, because of that unusual circumstance, it's not as instant as it appears. It's also still, if you look at the price to earnings ratio, it's still a significantly undervalued company, regardless of which earnings you use. So still trading at roughly a 6 PE. Which is actually lower than the 9 PE when we first recommended it. So it's still a growth company. It also was just added to the S&P 500. This means essentially that you will continue to see an influx of capital into American Airlines, despite the fact that Deutsche Bank just downgraded American, Delta, and UAL in a clear manipulation move today. But over the next several months, we still continue. I mean, get on an airplane. Anybody been on an airplane lately? Can you get a seat? Are flights full? Absolutely. Delta, American, United Continental, passenger traffic at record highs, labor peace at record lows, if you will. They've cut back on schedules, so they have fuller flights, they have fewer flights, their operating costs are decreasing. Their operating costs are decreasing further with the price of oil. So there's more that goes into just, I mean, we use that one number as the conduit for identifying that company that's undervalued, but as part of our program, this is some of the fundamental analysis that we're doing in the background for our members. So when we give you a stock, you've got a story. You have a reason for buying that company. We actually just recommended another airline for the month of April, and when you join, you can find out which one that one is. But they have a very similar story. So let's take a quick look here. James says, actually, Frank, why didn't AL get stopped out at 30, 5 or 6 entries after? Great question, and I'll tell you why. Does anybody remember what was happening right at the beginning of October last year? I'll give you a hint. CNN, MSNBC, Fox News, every news organization in essentially hysteria mode. Does Ebola ring a bell? Remember the Texas healthcare worker who took a continental flight from, or a United Continental flight from Texas to Cleveland, and basically created this massive scare that Ebola was going to suddenly spread through airline travel? Didn't happen. But those 6 red bars that you saw at the outset of April, again, are indicative of when we make a rational assessment of one of our trades, and we told people, here's what's happening with American Airlines. And it was also happening with Delta at the time, because we also had Delta as a stock selection. And we told people, you're going to be in the red, and our loss trigger is going to be breached. It will be a short-term event, because it's based on program trading, which is trading the headlines, and all of those headlines, 24 hours a day for the first 14 days of the month, were largely based on Ebola. So, you can go look, you'll see the exact same pattern on almost every airline, in whether it's Southwest, whether it's Alaska Airlines, UAL, American, Delta, etc. They all follow the same pattern. That's indicative of program trading. It is not indicative of the overall market trading lower, or just the overall market trading lower. You have that exacerbating, but at the same time, so you have this hysteria of Ebola, and at the same time you have oil prices beginning that initial precipitous decline. So we told our members to sit tight on American Airlines. U.S. Silica, though, if you look at that trade, that one got down to its floor, and we told people to exit that trade. And we had a fundamental reason, a fundamental rationale for making that exit call. So that's one of the reasons why I show American Airlines, even though it's an unusual circumstance in that case. Yes, your loss trigger was breached, but there was a fundamental reason for holding that trade. And as long as you have that fundamental basis, if your decision trigger is breached, you can stick it out for a couple of sessions, and you'll usually see that you're proven right. But a great question and great analysis by Frank and James there, guys. Good job. Do you wait for the daily bar to close before execution? Typically, we will make all of our trade recommendations in the when the markets are closed. So, for example, unless there's something really crazy or spectacular going on. So typically what we will do is tell people to exit the next day after 10:30 a.m. So you let the first hour of trading elapse, and then close with a market order anytime after 10:30. So that's how we do that. Have you tested this approach during a bearish market? We don't have a bearish market. We have a very wide channel of 5% on the S&P 500, which makes it difficult to identify when you're actually going to be in a bearish market. The key thing is you can't be afraid of a bear market. The risk management and the money management tactics that are as part of the plan and the rules will protect you against a bear market. What's the worst that would happen is you'd close out 10 trades with a 10% loss each, and you're done. You're not down 20%, you're not down 30%, you're not down 40%, you're done and out at 10%. And when the markets recover, which usually they recover within 12 to 14 weeks of a bear market, you have 90% of your capital preserved, and you can get right back into the market. So don't worry so much about bear markets, because that's what prevents you from, that's fear. That's fear asking that question. The rules are what remove that fear for you. So you can break the rules from time to time in your favor. We do. From time to time, you're going to have to, but you'll get comfortable with it when you start working with us, because you'll understand, again, there's a fundamental rationale for holding a trade. You're still winning stocks at the end of the month before the 20% target. Sometimes we will. Generally speaking, we're looking for that 20% target, and we want to give a trade 90 days or up to 90 days. Over the last 16 months, the average PE gap gets to that. The average number of PE gap stocks reaching that 20% target is 67%. So roughly 2/3 of the stocks will get to that 20% target. The average length of trade is about 81 days. So that's why we try to stick with them and give them enough time to maneuver. If we get stuck in a sideways chart, though, and that can happen, we've had a number of stocks that have been moving somewhat sideways because of the volatility in the overall markets, you can exit a trade with whatever. Remember this one thing. Write this down, because it's the only thing that matters. You're never, ever wrong for taking a gain. Ever. You're never wrong for taking a gain, because most traders, most investors don't take them. what they have are always paper gains, right? Some guy will tell you at the water cooler, yeah, I'm up 1,000% on Apple. You're not up until you close the trade. You all know that, so I'm not going to soapbox that one for you. But that's the key thing to understand. You're never wrong for taking a trade, and taking a gain. And from time to time, if we come up on, say, an earnings event, and we're concerned that the company may actually perform poorly, and we will exit the trade before the earnings event occurs. Most of the time we'll hold through earnings because we're not worried about that. But from time to time you'll find a company like in the housing industry in the last quarter. We had to exit a couple of trades because heading into earnings season we knew the housing market was weak. So we took a 2% gain and a 2% loss. We would break even across 2 trades. So you can make those kinds of decisions. From understanding 5% on only 10% of the portfolio. No, Vicky, you're annualizing the numbers incorrectly there. So let me help you with that. You're looking at a percentage per month. What you're saying is 6% per year, a 0.5%. If you're getting 1 to 2% per month, let's just use 2%. That's roughly 28% per year. So that's substantially higher. That's 1 to 2%. So 1 to 2% would actually be consistent with, we'll say 2% again. 2% per month on your money would be consistent with winning 40% of the trades and losing 60. So you can lose 60% of these trades and still make 2% per month. And at 2% per month, if you are compounding that money, because remember, the money you make in the first month has to get put to work in the next month. That's how you compound your money. But over the course of 12 months, that would be upwards of 20, I think it's 26.4% over 12 months. But no, it's not 6%, which is not buy and hold. So the math wasn't correct there, but it's a good question. I appreciate you asking that. Why only 10 stocks, not say 10 high and low risk? We're looking for the 10 best opportunities, Jay. So we want the 10 best stocks that have the best opportunity in that particular month for growth. Again, simplicity in managing your positions is very important, especially when you have rules. If you have too many stocks, it becomes a little too difficult. It can be a little too difficult to manage rules. The other part of it is, quite frankly, we are largely focused on in our program helping investors, and most of the folks who are in our program are still working, so they don't have a lot of time to manage 20, 30, or 40 stocks in a portfolio. So that's why we've always aimed to keep it with a relatively simple approach. We do what works best and stick with what we do best. So again, after the 60 days, folks, you can continue on for $79 a month, or we give you a one-time sort of 33% discount on the annual price if you choose to continue on and stick with the program. Who picks the stocks? Do I go through and calculate? No, we pick the stocks for you. We tell you what those 10 stocks are, and as I showed on this is an example. James, you'll see the 10 stocks. We do all of the math for you. We give you the analysis for the portfolio, so you know which stocks you're buying, why you're buying them. We give you the actual entry date, so you know when to buy them. Generally speaking, it's always going to be the first trading day of the month. From time to time, if that trading day falls on an unusual market day like jobs number day, we may delay our buying by a day just to avoid some of the excess volatility in the marketplace. But generally, we're in at the beginning of the month, and then we're holding for those targets. Let me see. Don't you need to normalize the PE gap number to adjust to the context of the sector? No, you don't. A good question, but no, you don't. Because what you're looking at, Judy, or what you're looking for are companies that have growth potential. The sector isn't relevant to that growth potential. Growth potential is only relevant to a corporation and the way that they manage their business. Either a company is going to grow or it's not. So there's no way to normalize something against the sector. You know that, for example, we can discount energy companies right now because of the decline in oil. So we can say that this is not a sector we want to be trading in at this particular time, but at some point in the future we will, because all of those earnings growth rates are being driven down right now along with the price of oil. So the market analysts essentially do that work for you by increasing or decreasing the earnings estimates based on their outlook for the company as part of what's happening in the overall economy and or a sector. So we don't have to do that work because they're doing it for us, and we don't have to pay them to do that, which is even a better benefit. everybody's asking about bear markets. Folks, you're in an uptrend. Take a look at an S&P chart. The markets are going to continue to go up. In a bear market, you can do three things. There are only three things that you can do in a bear market. It doesn't matter what strategy you're following. It doesn't matter what program you're a part of. I don't care whether what you're trading. There are only three things you can do. You can either take advantage of it, you can run and hide from it, or you can sit steady. You can bet with it, if you will. So you taking advantage of it means you short the market. The way to short the market in our model is from time to time we'll incorporate inverse ETFs if the market dictates that. In the case of an overall, I mean, if you have like a financial collapse, then again, you can sit on the sidelines. You can keep some of your positions in cash, which we have done from time to time. So in other words, what you do is you reduce your overall exposure to equities by leaving some of those buckets in cash. We have done that. We did that last July and last August, and both times we reduced our overall exposure to about 50%. So we only had 5 stocks instead of 10, and that allowed us to avoid the worst of the stock market, yet we were still able to capture 20% gains on several of our stocks in those time frames. So again, in a bear market, those are the only three things you can do. You can either bet with the bear market, ride the wave, or sit tight, get out. I mean, those are really the only three choices that you have. So, but you can't be afraid of a bear market. A bear market is still an opportunity to make money. It's just the other way. And the other part of that equation is all stocks do not go down in a bear market. The common misconception, you do not have 100% declines across the board in a bear market. You can go back and look at 2008 and 2009, and you will find stocks between October of 2008 and March of 2009 that still had substantial increases in overall valuation in the price. So the mistake is to think that everything goes down. Everything doesn't. One thing goes down, another thing goes up. Momentum stocks go down. Defensive stocks go up. Utilities go up. So you have to understand it's not as simple as saying what happens in a bear market, because it's much more complex than that. But they're great questions, and again, we have over 700 people in this program, so we know that it's on the forefront of everybody's mind because it's recent history. Anyway, Dan, just a quick check. I want to make sure that I'm not running over. I want to make sure that you're able to get on to the next one. I'm only going to take about 2 more questions here. First one is options. We do not use options in the Millionaire Blueprint program. There's 2 simple answers as to why. Not every stock we recommend is optionable. By optionable, I mean bid-ask spreads can be substantially wide on some of these, and liquidity can be substantially low, which means that you don't have an opportunity to really profit using an option. The second reason is, again, because we're largely working with a number of investors, many of them don't trade options or don't want to trade options. If you're an options trader, when you're working with the Millionaire Blueprint program, when you see the stock selections we're making, you will know how to make and construct your own options trade. The one that I always recommend, especially if you have a large enough portfolio and that you can buy a minimum of 100 shares, is to do nothing with options until we get to that 20% target, and then to sell covered calls against your stock outside of the 20% target. So you get the 20%, you get the value of the option because you're selling it, not buying it, and then you also get the price appreciation from whatever strike price you sell a covered call at. That's the best way to use options if you have enough capital in your portfolio. And the last question that we will take here, when is the subscription deadline for the special rate? Infinity, Abdul. This is the same rate that we offer every month at $79. It doesn't go up, it doesn't go down, so it's always $79. Thank you for asking. Previous question: material stock will trade narrower, less gap than a tech stock. From a chart perspective, Judy, absolutely. You have to, from a charting perspective, some stocks will have higher beta versus lower beta. So when we're doing our scans, when we're looking at the stocks, we're typically looking for stocks that have a beta of 1 or higher, so that they're moving with or higher than or faster than the overall stock market. Low beta stocks doesn't mean they can't move 20%. It just takes them a really long time to get there. But a good question. And Vicky, 1 to 2% of only 10% of overall portfolio. I'm not sure I got the question there, Vicky. 1 to 2% of only 10% of overall portfolio. Don't understand the question. I apologize. Do avoid stocks that have earnings report that month? Did sort of address this, Varani, just a little bit ago, but again, not necessarily. In fact, one of our stocks is Sportsman's Warehouse is reporting earnings after the market today. We told all of our new members not to add that stock to their portfolio for April, and the only reason was because they were reporting earnings today. It's an unknown event. We don't know how the market will respond to it between today and tomorrow. We did not want, the company could beat earnings and go up 20%. The company could miss earnings and go down 10 or 15%. It's an unknown event. We didn't want people to take sort of unmitigated risk with that particular stock selection, so we told them not to add it to their portfolio for the month of April. But it's a great question. So, all right, that's about all the time that I have, so I can get you back on track, Dan. And I want to thank everybody again. Join us at millionaireblueprint.com /win, millionaire-blueprint.com, sorry, /win, and we'll be happy to teach you everything you need to know. We'll get you in. You can get your stock selections right away. The hotline to reach us via email will be open to you immediately. So as soon as you reserve your spot, you'll be able to start getting questions answered from Jamie and or me today. So, Dan, with that, I will stop there and turn it back over to you.